With the U.S. markets now closed for the weekend, NUBURU, trading under the ticker BURU, finished Friday's session October 31, 2025 at $0.3386. That's a fractional gain of just 0.27% or less than a tenth of a cent. But that flat closing price hides the absolute chaos that happened during the day. The stock was on a wild ride, trading in a huge range from a low of $0.3213 to a high of $0.3741, and it did so on mind-boggling volume of over 101 million shares. For a stock at this price level, that is an astronomical amount of activity, suggesting an intense battle between buyers and sellers and a massive amount of speculation. Many investors see NUBURU and think they understand the story. It's that high-tech company with the special blue lasers for welding copper, a perfect play for the electric vehicle boom, right? That's the expectation. But the reality, and the reason for that 101 million share volume, is that you might not even be investing in the company you think you are. The NUBURU of today is in the middle of a radical, high-stakes pivot that completely changes the entire thesis for this stock, moving it from an industrial tech play to something else entirely. What we are seeing is a company scrambling to redefine itself. The general belief, the one that got NUBURU its initial attention, was built on its proprietary blue laser technology. The physics are compelling. Unlike infrared lasers, the blue wavelength is highly absorbed by materials like copper, which is notoriously difficult to weld. This, in theory, makes NUBURU's technology a perfect fit for manufacturing EV battery tabs, electric motors, and advanced electronics. This is the story that gets retail traders excited, the kind of narrative that spreads quickly on forums and social media, leading to heavy trading on platforms like the Robinhood app or SoFi Invest. The expectation is that they could become a key supplier, a picks and shovels play on the entire EV and electronics industry. Maybe not a Tesla stock itself, but a crucial part of its supply chain. But the market's recent behavior and the company's own press releases paint a picture of a company facing a much harsher reality. That original blue laser story, while technologically interesting, has been a commercial nightmare. The company has been bleeding cash, and the recent financial reports confirm this. Let's look at the hard numbers, the reality behind the narrative. As of its second quarter filing this year, NUBURU had only $111,090 in cash. That's not a typo, $111,000. For a publicly traded company trying to commercialize advanced hardware, that's not just a red flag, it's a siren. The company itself included a going concern warning in its filings, which is the official accounting language for "we have substantial doubt about our ability to continue operations without a significant injection of new funding." That funding finally came in September, when the company managed to raise $12 million through a public offering. But look at what's happened since. That cash isn't being primarily funneled into its core laser business. Instead, NUBURU has announced a complete strategic transformation. It is pivoting, and pivoting hard, into the defense and security sector. That's the reality that the market is trying to digest, and it's why the trading volume is so high. In just the last few weeks, NUBURU has announced a flurry of activity that has nothing to do with EV battery welding. They announced a strategic alliance with Maddox Defense to create a joint venture focused on next-gen drone technologies. Then, just yesterday, they announced the first phase of an acquisition of Orbit SRL, an Italian company that specializes in defense-grade software for operational resilience and crisis management. This isn't a minor shift, it's a completely new business model. The company is effectively attempting to become a defense tech holding company. This pivot explains the corporate chaos as well. On October 1st, they appointed co-CEOs, a move so abrupt it earned them a warning letter from the NYSE American Exchange for failing to provide proper advance notice, a compliance issue they have since reportedly cleared. It all points to a company in a desperate scramble. The $12 million they raised isn't a war chest for growth, it's survival capital being used to quickly buy into a new and hopefully more lucrative market. This changes everything for an investor. You are no longer betting on the adoption of blue lasers. You are betting on management's ability to integrate disparate defense companies, a business they have no historical track record in. This puts the stock in a category that most traditional investors wouldn't touch. This isn't a name you'll find in Fidelity mutual funds or as a core component of Schwab Intelligent portfolios. Those platforms are built for steady, long-term investment and wealth generation, focusing on established companies like Apple stock or the dominant NVIDIA stock. BURU, on the other hand, is the epitome of a high-risk, speculative microcap. It's a stock for traders, perhaps using a platform like Interactive Brokers to manage a very small high-risk position, or for retail speculators on Robinhood who are drawn in by the drone and defense headlines. The risk profile is binary. The approval by stockholders in July to increase the number of authorized shares from 250 million to 900 million tells you all you need to know. The company plans to fund its new strategy by printing and selling massive amounts of new stock, heavily diluting anyone holding it. They are using their stock as a currency to buy these new businesses because their cash position is so precarious. So what does the future hold? The expectation the company wants to sell is that they are building a diversified, high-growth defense and security platform. They are targeting a multi-billion-dollar market and are making aggressive moves. The reality is that this is a Hail Mary pass. They are a company with a failing core business, a near-zero cash balance prior to the recent raise, and a new, unproven strategy that relies on diluting shareholders to fund acquisitions. The 101 million shares traded on Friday represent this fundamental conflict. Some are buying the new dream, betting that one of these acquisitions could be a lottery ticket. Others are likely the long-term holders of the blue laser story, finally giving up and selling their shares, while short sellers are likely piling on, betting the whole thing will collapse under the weight of its dilution and debt. NUBURU is betting heavily on this complete change in direction. Comment below, do you see this as a brilliant strategic pivot or a desperate last-ditch effort? In the end, analyzing NUBURU is not about PE ratios or dividend yields. It's about survival. The original expectation of a pure-play, high-growth technology company is dead. The new reality is that NUBURU is a special situation microcap, a turnaround play that is attempting to use its public listing as a vehicle for a complete M&A-fueled reinvention. This is not a stock for self-investing beginners or for anyone's retirement account, whether it's a Fidelity IRA or a SoFi brokerage account. This is a speculative instrument. The tension between the promise of a new, exciting defense business and the brutal reality of their financial situation and massive dilution is what will define this stock's path. The story has fundamentally changed, and any investor who hasn't recognized that is trading on information that is dangerously out of date. Disclaimer: Finance. This content is for educational and informational purposes only. It is not financial, investment, or trading advice. Always do your own research or consult with a licensed financial advisor before making any investment decisions. Like, comment, reshare. If you found this helpful, don't forget to like, drop your thoughts in the comments, and share this with your friends and community. Your support helps us grow and bring more valuable content.